Old Mutual has delivered solid results. The financial services group has posted annual adjusted headline earnings of 6.6 billion rand. That's an increase of 14% thanks to rising demand for the firm's short-term insurance and wealth management products in South Africa. While adjusted headline earnings per share jumped 17%. This was supported by the company's 1 billion rand share repurchase program in 2024, which reduced the weighted average number of ordinary shares. A final dividend of 52 cents has been declared. This brings the total payout to 86 cents for the year. Looking ahead, Old Mutual expects its OM Bank unit to be fully functional by the fourth quarter and for the division to break even by 2028. Libstar has taken a knock. The food producer and distributor has reported a loss per share of 54 cents. That's from earnings of 38 cents previously. The swing is due in part to higher impairment charges. Libstar has had to shoulder a 400 million rand impairment charge on the Finlar Fine Foods business. That's as a major customer implemented a supplier diversification strategy, and this affected beef volumes at Libstar's food service unit. An impairment charge of just over 98 million rand has also been recognized in the Denny Mushrooms division. Super Group has reported a weaker financial performance for the 6 months ended December. The transport and logistics provider has posted a 7.6% drop in revenue. It attributes this to a weaker showing at its UK dealerships and supply chain Africa commodity businesses. The group's supply chain operations in Africa were weighed down by a significant decline in coal export volumes. That was largely owing to disruptions caused by the unrest in Mozambique during the final quarter of 2024. Headline earnings per share fell 24%. For the second half of the year, Super Group expects to perform at slightly better earnings levels, but that will only be the case if its Southern African commodity supply chain businesses improve, particularly in terms of copper exports. Patrice Motsepe's investment outfit, African Rainbow Capital Investments, has thrown in the towel on its listing on the JSE. This follows years of persistent discount in net asset value, which has been above 40% since its listing on the local bourse. The company's prized assets include Time Bank and Alex Forbes, and it says that the delisting will return more value to shareholders. The announcement comes alongside the group's interim results. It shows some inroads were made in reducing the discount at which the share price is trading. Intrinsic net asset value growth of 4.1% has been reported. The firm says over 99% of its portfolio is now defined as high growth or mature, with only 6 companies remaining in the early stages of their life cycle. Remgro has flagged a profit bump. The investment holding company expects headline earnings per share to be as much as 43% higher for the half year. It cited an improved performance across its portfolio as a reason for the rise. The firm says lower finance costs and the absence of corporate action also helped. Results will be released on the 25th of March. Bytes Technology has hit a milestone. In the year to end February, gross invoiced income comfortably exceeded £2 billion for the first time. That's as the UK-based firm enjoys continued demand for its services. According to a trading update from the group, the company has achieved double-digit growth in its key financial metrics: gross invoiced income, gross profit and operating profit. Bytes will release its annual results in May. Gauteng is facing a liquidity crisis that could deepen if resources are not spent prudently. That's according to the province's finance MEC Lebogang Maile. While tabling his 572 billion rand budget over the medium-term expenditure framework, Maile outlined the provincial government's plans to maintain fiscal discipline and credibility while improving service delivery. These include managing safety, the economy, climate change and debt against the backdrop of a deteriorating fiscal position. Maile says the province's net cash balances are projected to be negative by 2025-26 unless strict measures are implemented. Economists are divided about the direction of interest rates. That's according to a Business Day survey. Responses from 8 leading economists show a 50-50 split on whether the Reserve Bank will respond to global and domestic risks and hold rates steady at 7.5% or cut by 25 basis points. The MEC's decision will be announced on Thursday, but while opinions differ on the immediate rate decision, 6 of the 8 economists agree that interest rate cuts are likely later in the year if inflation remains stable and global conditions don't worsen. Further afield, Libstar, Intel's new CEO, is planning a major overhaul targeting chip manufacturing and artificial intelligence strategies for the struggling tech giant. Here's more detail in this report.
Intel's incoming CEO, Libstar, is reportedly considering significant changes to its chip manufacturing methods and artificial intelligence strategies. That's according to 2 people familiar with the matter. It comes ahead of his return to the company on Tuesday in a sweeping bid to revive the ailing tech giant. The new trajectory includes restructuring the company's approach to AI, as well as staff cuts to address what Tan views as a slow-moving and bloated middle management layer. The sources added that one of his core priorities would be revamping the company's manufacturing operations. According to 2 other people briefed on the matter, at a town hall meeting following his appointment as CEO last week, Tan told employees that the company will need to make tough decisions. Tan is former CEO of chip design software firm Cadence. He was a member of Intel's board until he resigned last August. In returning at the helm, Tan is set to take over the American icon after a decade of multiple CEOs, in which it failed to build chips for smartphones. It also missed surging demand for AI processors. That allowed rivals ARM and Nvidia to dominate those markets. Intel reported an annual loss of $19 billion last year, its first since 1986.